IAS 17, International Accounting Standard number 17. Now, you need to know a definition of the term lease. Definition of the term lease. So, a lease is a contractual agreement. A lease is a contractual agreement between two parties, one called the lessor and the other called the lessee. One called the lessor and the other called the lessee. Whereby the lessor conveys an asset to the lessee. The lessor conveys, or if you want, conveys or transfers an asset to the lessee for a specified duration of time. For a specified duration of time, and the lessee on the other hand, pays lease rentals to the lessor. Pays lease rentals to the lessor as consideration for the leased asset. Now, that is definition. The other thing that you need to know is about the types of leases. Number one, finance / capital lease. Finance or rather capital lease. So you write below that. Under this type of lease, the lessor substantially transfers all the risks and rewards associated with the leased asset, the risks and rewards associated with the leased asset to the lessee. Full stop. This type of lease usually takes a significant proportion of the economic life of the asset. The other type of lease is operating lease. Under this type of lease, under this type of lease, the lessor does not substantially transfer. The lessor does not substantially transfer the risks and rewards, associated with the leased asset to the lessee. Full stop. In this case, the lease period takes an insignificant proportion. The lease period usually takes an insignificant proportion of the economic life of the asset. An insignificant proportion of the economic life of the asset. The third type of lease is known as sale on leaseback transaction. Under this type of lease, the seller of an asset sells it to the buyer. But immediately leases it back. From the buyer. And becomes the new lessee. And the buyer becomes the lessor. And the buyer becomes the lessor. Full stop. This type of arrangement is mostly appropriate. Where the seller is in need of immediate lump sum cash. Full stop. Then below that you write accounting for lease, where lease rentals are paid in arrears. Accounting for lease where lease rentals are paid in arrears. Full stop. That's a subheading. Then you write it arises where lease rentals are paid at the end of each period. It arises where lease rentals are paid at the end of each period. In this case, the amount of interest, in this case, the amount of interest is based on the outstanding amount, before payment of the lease rentals, before payment of the lease rentals, before payment of the lease rentals. Full stop. Illustration, question, illustration. Illustration question. BD Limited leased an asset from an equipment from 𝘍𝘍𝑍𝘐 Limited on 1st January 2015. On 1st January 2015 for shillings 870 million. For shillings 870 million. Full stop. The equipment was expected to have a useful life of 6 years. The equipment was expected to have a useful life of 6 years. And the lease period was also 3 years. And the lease period was also 6 years, sorry. And the lease period was also 6 years. And the lease period was also 6 years. Full stop. The implicit rate of interest on the lease was 10% per annum. Was 10% per annum. Full stop. Annual lease rentals which were payable in arrears. Annual lease rentals which were payable in arrears amounted to shillings 200 million. Full stop. Amounted to shillings 200 million. Full stop. Required. Prepare in the books of BD Limited, for each of the 6 years, you put a full colon, part A, income statement extract, and part B, statement of financial position extract. Income statement extract and part B, statement of financial position extract. Now, whenever you are given a question on leases, it doesn't matter whether lease rentals are paid in arrears or in advance. You must always start by preparing a lease repayment schedule, or what we call a lease amortization schedule. Lease repayment schedule. We have 6 years here. 1, 2, 3, 4, 5, 6. Then we have the balance brought down. That's another column. Then interest at 10%. Then cash paid, that is the lease repayment. Then principal repayment, and finally balance carried down. And finally balance carried down. You have our figures are in millions. Our figures are in millions. Our figures are in millions. Then year 1, you start with the fair value of the asset. You start with the fair value of the asset, which is actually 870 million. Which is 870 million. Interest on the lease is at the rate of 10%. Is at the rate of 10%. So once I take 10% of 870, this gives me 87 million. Cash paid every year is 200 million. And therefore, it goes without saying that the principal repayment, if the total cash paid is 200, out of which 87 million is interest, then it means that the principal repayment is the difference between 200 and 87, which gives me 113 million. And therefore, our balance to be carried down is 870 minus 113, which is the principal repayment. So 870 minus 113. This gives me 757 million. And the balance carried down for year 1 becomes the balance brought down for year 2. Interest is 10% of 757, which is 75.7. Each time cash is being paid, they are paying 200 million. And therefore, the principal will constitute of 200 million minus 75.7. This gives me 124.3 million. And therefore, once you subtract it from 757, you get 632.7 million. It becomes the opening balance for the 3rd year. Then you take 10% of that, which is 63.27. Cash paid is constant at 200. And therefore, the principal repayment, once you subtract 63.27 from 200, principal repayment in this case will be 200 minus 63.27. It gives me 136.73. Once I subtract it from 632.7, I get 495.97. It becomes the opening balance here. 10% of that is 49.6. It's 49.6. 49.6, cash payment is 200 each year. So 200 minus 49.6, 150.4. Once I subtract it from 495.97, I get 345.57. It becomes the opening balance here. 10% of that is 34.56. Cash paid every year is 200. So 200 minus 34.56, 165.44. Once I subtract it from 345.57, I get 180.13. 180.13 becomes the opening balance here. 10% of that is 18.01. Cash paid every year is 200. 200 minus 18.01, I get 181.99. 181.99 minus 180.13, you get 1.86, which is a rounding off effect, and therefore you round it off to 0. That very small figure is arising as a result of rounding off effects. So that's how you prepare a loan or a lease repayment schedule. And now that we have our lease repayment schedule in place, we can now prepare the income statement extract. So you write 𝘊𝘍𝑍 Limited income statement extract. For the year ended 31st December 2015, 2016, 2017, 2015, 2016, 2017, 2018, 2019, 2020. Now from there, incomes or expenses, we have interest expense. Interest expense for each year, you are going to use this column, which is 87, 75.7, 63.27, 49.6, 34.56, and finally 18.01. Then from there, we have depreciation. This equipment cost 870 million. If you divide by 6 years, annual depreciation will be 145. So you put 145 all through. And that's how you prepare the income statement extract. That's how you prepare the income statement extract. Now we go to the SFP extract. So statement of financial position extract. Again, we have year 2015, 2016, 2017, 2018, 2019, 2020. We have non-current assets. Our figures are, of course, in millions. Non-current assets. equipments. The original cost was 870, but it lost 145 in year 2, remaining with 725. In year 2, it lost another 145, remaining with 580. Year 3, it lost another 145, remaining with 435. The other year, it lost another 145, remaining with 290. The other year, it lost with another 145, remaining with 145, and eventually remaining with 0. Eventually remaining with 0. So it's just a matter of starting with the cost of the asset, then you subject it to depreciation throughout its useful life. Then we have what we call obligation under finance risk. Obligation, non-current liabilities, we call it obligation under finance risk. Obligation under finance risk. And it will still appear under current liabilities. Obligation under finance risk. Obligation under finance risk. So we are going to put the non-current liability element up there, and the current liability element will appear down there. So in this case, the amount outstanding by the end of the first year is 757, out of which you are expecting to pay 124.3 in the next 1 year. So the non-current liability element will be 757 minus 124.3, which will be 632.7. And the trade continues like that. The other non-current liability is the one which follows, 495.97, followed by 345.57, followed by 180.13, and then dash dash. Then the current liability element is the amount which is payable within 1 year. So as far as year 1 is concerned, the amount payable within 1 year is this figure here, the 124.3. So 124.3 followed by 136.73, followed by 150.4, followed by 165.44, followed by 181.99, and finally dash. So the most important thing here is to separate the non-current liability element from the current liability element. The non-current liability element is the amount which is outstanding and payable. It's the amount which is outstanding and payable within a period exceeding 1 year. But the one which is payable within a period of 1 year is a current liability element. The one which is payable within 1 year is a current liability element. So that's how you need to differentiate between the non-current liability element and the current liability element. So that's how you account for arrears, where lease rentals are paid in arrears. Now the other thing that you need to know is how to account for a lease in case the lease rentals are paid in advance. So I just want you to write below there, accounting for lease rentals paid in advance. Accounting for lease rentals paid in advance. Accounting for lease rentals paid in advance. Then you write below that, where lease rentals are payable in advance, where lease rentals are payable in advance, where lease rentals are payable in advance, the amount of cash, the amount of interest for a given year, should be computed net of the lease rentals paid during the year. Net of the lease rentals paid during the year. Full stop. Illustration. ABC Limited leased an equipment from XYZ Limited. ABC Limited leased an equipment from XYZ Limited, ABC Limited leased an equipment from XYZ Limited for shillings 32.1 million. For shillings 32.1 million. 32.1. Full stop. The lease terms required annual lease rentals to be paid in advance. Annual lease rentals to be paid in advance. To be paid in advance at shillings 10 million. At shillings 10 million per annum. Full stop. The lease period was 4 years. The lease period was 4 years, which was equal to the economic life of the equipment. Which was equal to the economic life of the equipment. Full stop. The implicit rate of interest was 17%. The implicit rate of interest was 17% per annum. Was 17% per annum. Required. Show in the books of ABC Limited. Show in the books of ABC Limited. For each of the 4 years. For each of the 4 years. Part A, income statement extract. Part A, income statement extract. And Part B, statement of financial position extract. Part A, income statement extract. And Part B, SFP extract. As we have just said, it doesn't matter whether you are paying lease rentals in arrears or in advance. Whenever you are given a question on leases, always start with preparing a lease repayment schedule. But now this time round, the format of the lease repayment schedule will take a different shape, given the fact that the lease rentals are paid in advance. So we are going to see how the lease repayment schedule will appear in the books of ABC Limited. So you write lease repayment schedule. It is for 4 years. Year 1, 2, 3, 4. year 1, 2, 3, 4. Year 1, 2, 3, 4. Then you'll have a column for balance brought down, another column for cash paid, another column for outstanding balance, outstanding amount, another column for interest at 17% per annum, and then principal repayment, and then the balance carried down. Our figures are in millions. Our figures are in millions. We are going to start with the fair value, which is 32.1 million. Cash paid every year. Cash paid every year is 10 million. And therefore, outstanding amount at the end of year 1 is 22.1 million. Interest at 17% of that is 22.1 times 17%. That is 3.757. Principal repayment, you subtract that from the 22.1. Sorry, from the 10. You get 6.243. You subtract it from balance brought down of 32.1. You get 25.857. You bring it as a balance brought down. 10 million is constant. You are left with 15.857. 15.857 times 17%. It is 2.696. Then principal repayment, you subtract it from 10, you get 7.304. You subtract it from 25.857, you get 18.553. You bring it in the third year, 18.553. Cash paid is constant at 10 million. So once you subtract this, you are left with 8.553. Interest rate at the rate of 17% of that is 1.454. Principal repayment, you subtract that one from 10, you get 8.546. You subtract it from 18.553, you are left with 10. Then 10, you bring it in year 1, in year 4. Cash paid in year 4 is 10. No outstanding amount, no interest, no principal repayment, no balance carried down. Therefore, what is now remaining is now to prepare the income statement extract. So you write ABC Limited, income statement extract for the year ended 31st December year 1, 2, 3, 4. Our figures are in millions. Expenses. We have interest expense. Interest expense, you are going to extract it from this column, the column for interest. Where you have the column for interest, that's where you're going to extract the income expense figure. So it is 3.757, followed by 2.696, followed by 1.454, followed by dash or 0. Depreciation per year, depreciation. This asset costs 32.1 million and it has an economic life of 4 years. So 32.1 million you divide by 4 because you are not expecting scrap. So you get 8.025 and it is constant throughout. And that's how you prepare the income statement extract. Let's now have the SFP extract. Let's now have the SFP extract. ABC Limited. Statement of financial position extract. As at 31st December, you have here 1, 2, 3, 4. Our figures are in millions. Non-current assets. We have equipments. The original cost of these equipments was, I can see, was 32.1 million. Put it in on your calculator. Then it lost value in year 1 by 8.025. Remaining with 24 at the end of year 1, 0.075. It lost by another 8.025, remaining with 16.05. It lost with another 8.025, remaining with 8.025, and eventually remaining with 0. Eventually remaining with 0. Then we have non-current liability, which goes hand in hand with current liability. So you'll have obligation under finance risk. And it goes hand in hand with the current liabilities. Again, obligation under finance risk. So the non-current liability, the outstanding amount in year 1 is 25.857. But out of this, we are expecting to receive in year, or to pay in the second year, 7.304. And therefore, if you take this minus what we are expecting to pay in the next 12 months, you'll be left with 18.553, which is non-current as far as year 1 is concerned. So, non-current obligation under finance risk, which is non-current, is 18.553 in year 1. In year 2, you'll be left with 10. At the end of year 3, everything will be current, and therefore there will be no non-current liability in year 3 and 4. When it comes to current liability, as far as year 1 is concerned, what we are expecting to pay within 1 year is 7.304. 7.304 is expected to be paid next year. As far as year 2 is concerned, by the end of year 2, we are expecting to pay in the next year 8.546. At the end of year 3, since this amount is being paid in advance, you'll have 0, 0, because at the end of year 3 is the same as the beginning of year 4. And remember that these rentals are paid in advance. And therefore, there will be no non-current liability in year 3 and current liability in year 3 and 4, respectively. So that is how you account for a finance lease where these rentals are paid in advance. Supposing you are asked to show the books of the lessor, supposing the examiner requires you to show the books of the lessor cannot account for this depreciation here. And when it comes to these figures of interest, the lessor will account for them as incomes. The lessor will account for the same values. The lessor will account for the same as incomes, but will not account for depreciation, because in a finance lease, the lessor substantially transfers the risks and rewards of the leased asset. When it comes to the current assets and current liability element, these ones will be accounted for as assets. And instead of calling it obligation under finance lease, we are going to call it receivables under finance lease. So that's all you're supposed to know as far as IAS 17, that is leases, is concerned. Therefore, that's all about leases, both lease rentals paid in advance and in arrears. So in our next class, we are going to get to the other part of accounting for assets and liabilities, which is income taxes. So in our next session, we are going to see how to account for income taxes.